Start with a real story because this is happening right now to real people. I came across this post on Reddit a few months ago, and I think it kind of shed some light on it. So we were trying to sell our condo. We've had a buyer lined up. They are trying to get their loan finalized. We found out on February 19th, which I'm assuming is right before the close of escrow, that the reason their loan isn't going through is because the HOA has lost credibility with Fannie and Freddie. So now there's no conventional loan companies that will work with anyone trying to buy in our complex. They want to see a plan to get the reserves of $2.6 million with current reserves of $650,000. There are 208 units in our complex, many rented, built in the 60s. People here don't have enough money for the special assessment. HOA dues are already approaching $600 a month. Now this new issue means basically no one can buy without a non-QM loan. Basically, she's saying this is all new to me. Basically requires a large down payment and cost additional interest. Think about that for a second. This person owned their condo for years, had equity, had a buyer, had a closing date, and probably 3 days before the closing, the deal died. Not because of the market, not because of the buyer, because of something the HOA did or did not do years ago. And the worst part, they had no idea this was coming. That's what we're here to fix today. I've been doing mortgages in California for 25 years. I've seen deals fall apart for a lot of reasons. But what's happening right now with condos, this is different. Most buyers, they have no idea that it's coming. Here's actually what's going on. It's not just one problem, it's four. It's a perfect storm. And they're all hitting at the same time. 1, Fannie Mae's blacklist. 2, SB 326. 3, the reserve funds, or what we call the reserve budget. And 4, insurance. By themselves, any of these can be a headache. Together, a condo can become completely unsellable. So let's go through each one. I'm going to take a step back and go back to 2021, where this all really started. Surfside, Florida, 12-story condo just collapsed. 98 people died. Really sad. After that, Fannie Mae completely rewrote their rules. They probably got a lot of heat for this, so they got really tough on deferred maintenance, health and safety hazards. And if a building now fails that review, it goes on their mortgage blacklist. As of 2025, 733 condos were on that list here in California. 400 alone were in Southern California. Now, here's the part that really gets me. Most of these sellers, they don't know that their building's even been flagged. There's no letter from Fannie Mae. There's no heads up. Their HOA probably didn't notify them, or if they did, it came in some piece of mail that they threw out. They find out when their deal falls apart. I saw this thread. It says it all. I recently had an offer accepted on a condo in a building that is in need of structural repair. This was acknowledged, and there are plans in place to begin the work. Additionally, the seller agreed to pay the special assessment to fund the work. I had some misgivings about this, but my agent, pretty dismissive, red flag number 1 of them, assured me everything would be fine. By the way, you guys, when an agent is assuring you that it's going to be fine and not with documentation, red flag. I was working with a mortgage broker recommended by my agent, and everything was proceeding smoothly until I decided to check the mortgage rate with a different broker. She had a lower rate, so I started the process with her. But she came back to me a few days later to say they couldn't provide a mortgage because the building is on Fannie Mae's list of properties ineligible for mortgages due to its structural issues. My agent was CC'd on the email and simply told me that my mortgage broker was overreacting and his mortgage broker would be able to make it work. All right. You guys, first of all, this realtor should not be in the business. I'm just going to make the assumption. Based on that story, there's a lot of red flags, and it doesn't sound like they have the buyer's interest in place unless they've got documentation. Again, this is an assumption that substantiates that this is a good investment. And here's the important thing. Sellers, they have to disclose known material facts, but known is the key word. If they genuinely didn't know, and a lot of them don't, that disclosure never happens, and the buyer pays for it. So don't wait for someone to tell you. You've got to find out on your own by yourself. Not by yourself. If you're working with a good lender, they can help you out. So that's a little bit about the blacklist. Now let's talk about one of the fastest ways a building ends up on it. Okay, SB 326, Senate Bill 326. This one really trips people up. In 2019, California passed a law. Every condo greater than 3 units, the HOA had to hire a licensed structural engineer to inspect the balconies, decks, walkways, and exterior stairs. Not a property manager with a clipboard, not just some handyman, a licensed engineer. The deadline was January 1st, 2025. There was an extension that was pushed on it, but a lot of the HOAs just didn't do it. Some didn't know the law existed, which blows my mind. Some just kept pushing it off. Some did it, found real problems, and now they're staring at a 6-figure to 7-figure repair bill. So why does this affect your mortgage? When your lender reviews the condo project, they check SB 326 compliance. If the HOA missed the deadline, the lender flags it as an unresolved safety concern, or they have the engineer inspection report, but they haven't started the work. And that's an issue because if there's a massive amount of cost, that could break the budget. And that alone, it can trigger a blacklist designation. And here's the part that catches people off guard. It doesn't matter which unit you're buying. It doesn't matter if your balcony is perfectly fine. If the building is flagged, every unit loses conventional financing. Every unit, not just some, all of them. And even if the building passes the inspection, there's a second number that can sink the deal just as fast. It lives inside the HOA financials, and most buyers never ask for it. All right, the financials of the HOA, we call it the reserve budget. It's their savings account, and it's what they collect each and every month. They build up, and it's going to basically fund monthly expenses and hopefully future expenses. It could be a big ticket item like a roof. If they need a new roof in 3 years, they want to have the funds in that account to be able to pay for that. So very important. A 70% funded reserve budget is in good shape. 30% and below, that's a red flag. Anywhere in that middle, you got to proceed carefully and ask more questions. And Fannie Mae just raised the bar. As of March 2026, reserves now have to be at least 15% of the HOA's annual budget just to qualify for a conventional loan. Sounds low, and a lot of California buildings can't even clear that. Hey y'all, my husband and I are first-time home buyers, and we are currently under contract on a condo. We just got HOA documents today and are a bit overwhelmed with the information presented. On the reserve study, this is back in 23, it shows the association has a reserve fund of 31.7%. There are a few items on there. Thankfully, roof is not one of them that are reaching its end of life. The HOA would ideally need $395,000 in reserves to replace or repair all the items that require attention. However, the HOA only has $125,000. They raised the HOA fee at the start of this year from $485 to $497. Should we be concerned with this? Any advice would be greatly appreciated. If I'm doing my math correctly, they raised the HOA dues by $7 a month, and there are 24 units in here, and they've got $125,000, and the future fixes that they know they need to replace is $195,000. This is a really tough one because the buyers, they love that place. They're emotionally attached. And the good thing is they're still pumping the brakes and asking for advice. This 14% means the HOA is nearly running on empty. And when something breaks, and always something does break, they have two options, either a special assessment or defer the repair. A special assessment is a surprise bill to every homeowner. Could be $10,000, could be $50,000. In some California buildings this year, over $100,000 per unit. So doing your homework and asking questions on this reserve budget, it's really important. So now you've checked the blacklist, you've checked the reserves. There's one more piece that's been blowing up here in California over the past 2 years in a way that no one saw coming. Here's the part that surprises most buyers. State Farm, Allstate, Geico, Farmers, they all pulled out from California in a big way. HOA premiums up 100 to 400% since 2022. Some HOAs tripling dues just to cover the insurance. My HOA's insurance, which is the master insurance policy, it covers the whole entire complex, went from $195,000 a year to $500,000 a year. Is this normal? Are we getting scammed by the HOA management company? Or is this just the new norm? We had to pay a special assessment of $1,000 this year, and our HOA increased from $360 to $425 a month. This is a relatively new community in the North Natomas area. What can be done about this? Is this normal? This one's tough. This hits buyers in two ways. One, higher cost of home ownership. And two, and this is the one most people miss, if the HOA lands on some special insurance product because they can't get the normal product, that building can fail Fannie Mae's insurance requirement and then be put on the blacklist. The insurance crisis here in California, it's not just a dues problem, it's a financing problem. Here's the one thing I want to share clearly. A lot of people have been blaming SB 326 for all of this. SB 326 is not the reason your condo isn't selling. Seen this a couple times in this thread and have had questions directed to me as well. So want to clear up confusion. SB 326 keeps getting blamed every time a condo doesn't sell, and it's starting to feel lazy. The law's been in place since 2020. First required inspection deadline was January 1st, 2025. That person is right. SB 326, it didn't create this crisis, it exposed it. For decades, HOA boards kept dues low, deferred maintenance, underfunded reserves. They basically just kicked the can down the road. Those buildings in trouble today, They were already in trouble. Buyers, they just couldn't see it. Now they can if they know what to look for. Let me put a number on this. When a building fails Fannie Freddie's review, it becomes non-warrantable. Conventional financing, it's gone. FHA, VA, gone. So on a $700,000 condo, financing 2% above conventional rates adds another $700, $800 to your monthly payment. As an example, that could be a car payment on top of your mortgage every month. And when you go to sell, over 90% of buyers use conventional financing. And if your building is non-warrantable, those buyers, they can't buy your unit. Cash buyers might, but they negotiate a discount. Here's 5 questions before you make the offer on that condo. 1, is the building on the approved list? You can call your lender and ask them to check. You'll get 1 of 3 answers. Currently approved, decline, it'll have a reason why, or not yet approved, which isn't automatically a deal breaker. Just means more questions need answers. But it's really important. You want to know before you're emotionally invested. 2, is this HOA SB 326 compliant? Request the inspection report. They should have a copy of the report. 3, what is the reserve funding percentage? Again, it's called the reserve budget. Is it under 50%? Ask more questions. Under 30%? Serious caution. Number 4, ask your agent to request a copy of the master insurance policy. Ask for it, send it to your lender. That one document tells everything about the carrier, the coverage, and the deductible. And from there, they can tell whether it meets Fannie and Freddie requirements. Most buyers never ask for it. It's one of the most important things you can do. And number 5, have there been any sales in this complex that have fallen through due to financing in the last 12 months? This will give you better information on possible red flags that have existed because other buyers had gone into contract on a home and faced the obstacles that we just went over. This isn't meant to scare you away from condos. Condos, there's some great buildings out there. Well run, fully funded, completely warrantable, but the due diligence, it needs to go deeper now. That checklist, it really matters.